Hi there, it's Greg Boyer from Startup 101. So you've got a great business idea that you're ready to roll out. However, there's one big question that still remains unanswered. Is this business idea going to make money? Will it be profitable for you? And when do you find this information out? Well, today's video, I hope to answer those two questions for you. And it revolves around the exercise of financial forecasting. So what is financial forecasting? In essence, it's a process by which the business owner thinks about and predicts the future financial results of the business. It's an exercise that should be done by business owners on a regular basis for the life of the business, because it helps prepare budgets, overcome risks, manage finances, etc. However, for today, I only want to talk about the exercise that you should do when you're ascertaining if your business idea is going to be financially feasible. So in this case, I only want to talk about two components of financial forecasting, and they are cash flow and profit and loss. So let's talk about cash flow first. And what is it? The cash flow forecast shows the money that is moving in and out of your business every month. The role of it is to show whether the business has sufficient money in the bank in the immediate term to pay off bills and remain solvent for each month. A cash flow statement can identify when the business owner needs to borrow more money, as well as investing more equity into the business to cover any cash flow shortages. Basically, a cash flow forecast shows how much cash or funding the business owner needs up front for the business before it can generate its own cash to pay all the expenses. The role of the profit and loss forecast is slightly different. It's there to show whether a business is making an annual profit using accounting principles, and is also used to show the business owner, investors, as well as any loan creditors like banks and so on, whether the business will be making a profit in the medium and also the longer term. Now, the reason why you need to do both statements when undertaking financial forecasting is that a company may look profitable through the profit and loss statement. However, the cash flow statement may show that there are more expenses than cash in the bank in the short term. Notwithstanding the business may be profitable after 1 year of trading, if it's unable to pay for its expenses in the first few months of business, it will subsequently fail. So let's have a look at an example of these two types of forecasts and show you what I mean. Here's an example of a forecast cash flow statement. It's made up of two main headings, being money in and money out, with monthly cash forecasts done for each subheading, giving you a yearly total summary. Now, with the money in heading, I've broken that into two subheadings, being direct revenue streams, like selling products, and the other being finance, like getting a loan from the bank or even equity from investors. The second main heading is money out. That includes capital purchases for things like assets, as well as normal business expenses like paying for consultant services, office rent, and even employment costs. In this example, the business brings in just over $442,000 over 12 months, but spends $564,000 odd, leaving a cash shortfall of just over $122,000. Also, for the first 5 months of the business, the net monthly cash flow is negative. It is not until month 6 that there's enough positive money coming into the business that it can actually afford to pay for itself. This shows the business needs finance to cover the negative cash flows for these first 5 months. However, now let's look at the forecast profit and loss statement for the same business. Compared to the cash flow statement, the two main headings on the profit and loss have changed. The first one is now revenue and the second one is expenses. The difference to the cash flow statement is that funding sources like bank assets, as well as equity investments, are not shown on the profit and loss statement, nor are asset purchases. As such, a large amount of money for asset purchases is not treated as an expense, and in this case, that enables the revenue of $442,000 to look a lot better because the expenses are lower than the previous money out on the cash flow. As a result, the profit and loss is actually showing a profit of just over $62,000, which is a good result, showing the business in the medium term of 12 months is actually profitable. However, if you didn't have the cash flow statement, the business owner would be unaware of the funding shortage and that it could actually fail by month 6. This is why doing both of the cash flow as well as the profit and loss forecasts are critical when undertaking financial forecasting of the new business. Okay, so that should give you the answers to how to find out if your business idea is financially feasible, both from a profit perspective as well as have you got enough cash to fund the business. So the next question is, when do you do this exercise? I would recommend that you should do the initial forecast early in your investigation phase of your business idea. Once you've completed the startup program or Gantt chart and done the initial investigation of the business idea to see if it would sell in the marketplace, I would then commence this financial forecasting exercise. This forecast is a critical point in your startup journey as it'll give you information whether your business idea is financially feasible, so you can then decide to continue with the startup process or pivot with the idea. It may be even a decision to abandon the business idea at this point if it shows it's definitely not financially feasible. If the results from your forecasting are positive and you decide to proceed with the startup process, I would then recommend this forecasting exercise is included in a feedback loop as you continue to investigate the business idea. So revise the startup Gantt chart, continue to investigate the market and find out more market information, and continually revise the financial forecast. So by the time you get to the end of the investigation phase, you'll have very clear data that your business idea will sell, it will be profitable, and you will know who you're selling it to. Okay, so I hope you found that information handy and helps you on your new business journey. If you have any questions about the topic, please don't hesitate to leave them in the blog section below, and I'd love to get back to you with some answers as soon as possible. Also, if you've got any family, friends, or colleagues that you might think this topic could help them as well, please feel free to share it. Love to get some likes, subscribes to the website so I can keep in touch with everyone and keep them updated with more information about the best way to start new businesses. So thanks again. My name's Greg Boyer from Startup 101. And remember, don't just dream about having a new business. Get out there and live your business dream. Speak to you soon. See you later.